What can I afford now? Is that affordability going to change? Should I wait and buy later, or should I try to buy now? All right, welcome back everybody. As I mentioned in my last video, there's a bunch of data and statistics and so forth that all play a part and frankly tell a clearer picture of what's happening right now in this changing economy. I'm going to try to break this down as concisely as I can because at the core of this is really the rising interest rate environment that we're in. Let's talk about what that means to you for a second. It just means, what can I afford now? Is that affordability going to change? And should I wait and buy later, or should I try to buy now? Well, let's try to break that down for a quick second. Again, all the forecasts right now are suggesting that we're going to see less activity, less appreciation, but probably not much of a decline, if any, in values. Conversely, we are expecting to see a rise in interest rates, which means that your affordability is going to take a hit. As interest rates go up, your affordability is going to go down. I'm going to try to talk to you about interest rates here for a moment. Keep in mind, I was a mortgage broker for almost 10 years, so I have a bit of a competitive advantage here. I can still speak that language somewhat fluently. Let me try to give you guys sort of a brief synopsis here. First of all, there's the federal fund rate. This is what you've heard Federal Chair Jerome Powell talking about. The federal fund rate is at around 2.25% to 2.5% right now. The Fed fund rate is the rate at which banks lend each other money. Okay, now separate from that, you have what's called the prime index. The prime index is the rate at which banks lend money to their qualified customers, well, unlike a home equity line of credit, for example. The prime index typically sits about 3% over whatever the Fed fund rate is. So if the Fed fund rate is 2.5%, that means that the prime index right now is around 5.5%. Now, what Jerome Powell said in his statement last week is that he expects the Fed fund rate is going to get to around 4 or slightly below it between now and 2023 and hover there for some time. That means that we're going to see the prime index go close to 7%. Interestingly, neither of these interest rates are directly tied to what happens to mortgage interest rates, which is what is meaningful to you and when you go to get a loan. A mortgage interest rate is more closely correlated to the 10-year yield. It's confusing, I know. Trust me, the good news is you don't need to be an expert on it. That's my job. Here's what you do need to know. Right now, the mortgage interest rates that are available to you are actually somewhat inverse to what we're seeing happening with the federal fund rate and with the prime index. The primary reason for that being there's a lot of strong key indicators still in our economy. For example, unemployment is still at 3.5%. And the banks, quite simply, are in the business of lending money. So if they're not lending money, they're not making money. So they've been incentivized to lower their rates a little bit because they've seen their volume in transactions drop. What does all this mean to you? Again, is it a good time to buy? Well, that's a very personal question, and I think that comes down to finding the right home for you and your family. You should consult with your realtor, i.e. me, about that. Is your affordability going to take a hit here in the coming months? Yes, it is. Interest rates are going to go up, and there's a teeter-totter effect between interest rates and affordability, or interest rates sometimes and home values. But because of that imbalance between supply and demand, we're not seeing the same teeter-totter effect that we've seen in the past. If you have any more questions, feel free to DM me directly. I'd love to talk to you about it further.